There's a difference between being profitable in your business and building value. Do you know what builds value? Is that an important thing that you need to think about right now? Lots of times businesses work on the eye of being profitable without necessarily considering the longer term value of things. So today we're talking about building value within your business. My name is Adam Hanneman. Welcome to Ramblings of a Geek. I talk to MSPs all the time in my day job, and we talk about making smart business decisions, things that compounded over time will yield a much bigger value for their organization while keeping their shorter term profits in a good spot as well. Because there is definitely a difference between generating profits for today and value for the future. Today, we're going to cover my top 5 ways of building value within your business. But before we do that, before we get into the meat of these things, it's important to talk a little bit about the time horizon, right? If you are looking to exit your business in 3 to 5 years, your time horizon is much shorter than somebody that wants to exit in 15 or 20 years in the future. So to understand that when you have a shorter runway, you must move a little bit faster and really lock into some of these value creation strategies. So make sure you're thinking about that as you go through this video. The things I'm going to cover today are going to be beneficial no matter how far away your exit is. So these are things that you can do at any stage in your business to continually build value, build organizational maturity, and those kinds of things. So let's head out on the ramble and let's talk about some things to build value. The first thing I want to talk about today is really the fact that your monthly recurring revenue, especially on the services side, is really king. You really want to drive that revenue up as much as you possibly can. Now, I'm not saying you should ignore break fix, you should ignore selling software and hardware and those kinds of things, but really the thing that builds the most value is lifting up that MRR. So make sure that you're paying attention to that. So that said, I know plenty of MSPs that make a ton of money when it comes to generating lots of profit through break fix and projects and those kinds of things. And so generating that short-term profit is not a bad idea. It's never a bad idea to make profit. But the idea is that as you grow and add new clients and those kinds of things, generating as much of that into monthly recurring revenue on the services side is going to yield you a much bigger profit when it comes to selling your business on down the road. The second piece of this is, as an owner, you must work your way out of the day-to-day. If your business requires you to be there all the time to kind of keep things moving, you're going to have a much harder time selling your business for top dollar. So if you think about my video that talks about the evolution of the owner role, and I'll link that above, of course. If you think about that video, it covers kind of how to shift your role as your company grows and as you progress through kind of the growth stages of your organization. So think about that video. Think about how to get yourself out of the day-to-day and hand off the technical stuff and hand off the projects and hand off the account management. And the further down that path you are and the less your company requires you to be around just to kind of keep the lights on, the better off you're going to be and the higher your valuation is going to be. The third thing is it's important to understand that larger businesses get larger valuations. Now, it's not as linear as that sounds, though. The idea is that you need to be a certain size in order for companies to really want to spend top dollar. And it's not to say that a smaller MSP isn't going to fetch anything on the open market. You just might have a little bit lower valuation just because you're a little bit smaller. So the good rule of thumb here is that if you're a $2 million or larger MSP in terms of top line revenue, you're a little bit more attractive to a potential buyer. Now, that's not to say that a smaller MSP won't ever get bought or won't get bought even for a sizable valuation. It's just a little bit harder to do it that way. This is where you have an opportunity as a smaller MSP to potentially merge with another one or maybe acquire somebody who's trying to exit the space. In some cases, in fact, many cases, 1 + 1 might equal 3 or 2 + 2 might equal 5 in this case, where you grow your business by acquisition and you get kind of whatever that next level is. And if you can kind of absorb those clients in and continue kind of that growth trajectory that you were doing anyway, you might end up in a much better spot from a valuation perspective. There are a couple benchmarks kind of along the way when you think about business valuation. The first one's kind of that 2 range. Then you got 5 and then kind of 10. And there's oftentimes another 1 or 2 in there depending on what's going on. But the idea is that if you get your company to at least 2 million, and especially if you can get closer to 5 or a little north of 5, you're going to be in a pretty good spot from a business valuation standpoint. The next thing worth talking about is building sustainable, consistent growth, right? If the idea is you want your company to kind of be going up and to the right as much as you possibly can, because if you can do that and you can move your company forward in a measured, repeatable pace, your company is going to be a lot more attractive to a buyer, especially because it's going to show that there's less risk. If you've been able to continually grow your organization without these huge spikes and valleys it's going to make your life a lot easier on the back end. And frankly, it's going to make your life a lot easier when you're running your organization anyway. So understand that the more consistent you can be, the better off you are. It's also important to understand that if you acquire a company, you might go like this and jump up. That's okay as long as you kind of keep moving your business up and to the right anyway, right? The issue is if you bump up and you come back down right away, right? If you bump up and you move and keep going, you're doing pretty good. So it's sort of that walk and chew gum at the same time. If you're going to acquire another business, you got to make sure that you're able to continue to be profitable and you continue to generate more revenue as you kind of do that as well. The next one's all about keeping your financials clean. As much as possible, you want a clean P&L and a clean balance sheet. And if you can manage it, have a budget that you're hitting on a regular basis as well. Having a budget you can hit with a clean P&L and a clean balance sheet is going to be really attractive to a buyer. The budget part's important because it says that you've been able to identify how big you want to be or what you want to do in a year, and you're able to hit it, right? That's a really important thing. But that clean P&L tells a different story. It tells the buyer that you know what you're doing, that you have built your business around lines of business, and you can extract all the data out appropriately, and they can understand what's going on without it being a mystery, right? The more and more risk and mystery you can take out of the transaction, the better off you're going to be. So get your P&L locked in early as best as you possibly can. In fact, I talk about this all the time in all of my peer groups and classes and whatnot, because understanding your financials is only going to help you in business. So make sure you understand that P&L and you get things allocated and aligned appropriately, so that way it's just an easier transaction when it comes to sell your business. The other piece, though, is it's really important to keep your balance sheet clean as much as possible. Now, I know as an owner, you can do all kinds of stuff. You can run a boat through your company, you run a plane through your company, you can run multiple cars, like whatever. You do you. It's your own thing. It's your business. Except when it comes time to sell your business, and if you have those things on your balance sheet and they're impacting things and they're showing up places, the buying entity is going to question those things, and they're going to become conversation topics and negotiating points. So if you are closer to your exit time frame, it might be time to kind of eject some of those things off of your balance sheet, especially if you can do it a couple of years in advance, because it's going to make that whole conversation a whole lot easier and a whole lot less frustrating for both you and for the buyer. Building valuation and preparing your business for sale ideally takes a number of years. Hopefully you're not in a situation where you have to sell like this year and it's a thing that's coming up right now. If that's the case, I would strongly recommend reaching out to somebody to help with kind of preparing all of the things, because that's a whole lot harder of a process to get through than if you were to say, I'm going to exit in 5 or 10 years and kind of do things along the way to kind of make things easier on the exit side of the world. So as much as possible, do your best to plan this out for a future exit, not so much a holy crap, I got to get out of the business today kind of a thing. One of the best steps for you out of this conversation is really to go get your business evaluated, especially if you're even sort of close to it. You want to understand kind of where you are for real. That way you're able to understand where the exit looks like. I'll drop a couple names down below in the description of this video for some folks I recommend. In the meantime, you can take a look at this video up here about the evolution of the owner's role as you grow. And this video up over here is going to be all about what your exit strategy might look like. Thanks for coming on this ramble with me, and hope to see you on the next one.